The automotive industry is facing a significant shift as Canada considers a major pivot toward European trade partnerships. This move comes in response to escalating trade tensions with the United States, particularly over tariffs. If Canada imposes a 100% tariff on Tesla vehicles, it could drastically increase the cost of models like the Model Y and Model 3. This would price many Canadian buyers out of the market. Beyond the immediate impact on consumers, Tesla also relies on Canada for critical battery materials like lithium and nickel. If access to these resources is restricted, Tesla could face higher production costs and potential slowdowns. This would not only affect the company's operations but could also lead to pricier electric vehicles in the US market. Additionally, Tesla's stock, which is highly sensitive to trade disputes, could experience significant volatility. Even the rumor of Canadian restrictions might unsettle investors, creating further challenges for the company's long-term growth. The ripple effects of this trade war extend far beyond Tesla. The US and Canada have shared a deeply interconnected automotive supply chain for over a century. Canadian factories supply essential components that American automakers like GM, Ford, and Stellantis rely on. If tariffs are imposed, the cost of these components could skyrocket overnight. This would force automakers to either absorb the increased expenses or pass them on to consumers. Given the competitive nature of the industry, it's likely that consumers will bear the brunt of these costs. This could lead to higher sticker prices at dealerships, potential job cuts, and slower production as companies scramble to restructure their supply chains. The disruption would not be limited to the automotive sector. Industries such as construction and consumer electronics, which also depend on Canadian materials, could face similar challenges. This would drive inflation across multiple sectors, making everyday goods more expensive for American consumers. Canada's potential pivot to Europe presents a significant opportunity for European automakers. Brands like Volkswagen, BMW, and Mercedes-Benz could thrive in the Canadian market under the Comprehensive Economic and Trade Agreement, CETA. This agreement allows for smoother trade between Canada and the European Union, giving European automakers a competitive edge. With fewer import taxes and a more EV-friendly regulatory environment, European electric vehicles could become the preferred choice for Canadian consumers. This would leave American automakers struggling to compete in a key market. The shift could force US companies to rethink their sales strategies and global partnerships. If Canada fully commits to this European alliance, it could reshape the entire North American automotive landscape. The escalating trade tensions between the US and Canada could have far-reaching consequences for American consumers. A 100% tariff on Canadian imports would not only impact automakers but also drive up the cost of raw materials like aluminum, steel, and battery components. These materials are essential for the production of electric vehicles, and their increased cost would likely be passed on to consumers. This would result in higher vehicle prices, more expensive repairs, and fewer affordable options, particularly in the EV sector. The impact would extend beyond the automotive industry, affecting everything from home appliances to smartphones. As raw material costs rise, inflation would spread across multiple sectors, placing a heavier financial burden on American households. The relationship between the US and Canada, which has been a cornerstone of North American automotive manufacturing, is now under serious strain. Tensions reached a boiling point in early 2025 when the US imposed a 25% tariff on Canadian and Mexican auto imports, citing national security and trade imbalances. Canada responded with a $155 billion retaliatory tariff package targeting key US exports. This has prompted Canada to explore alternative trade deals with Europe, reducing its reliance on American imports and exports. If this shift continues, the once unified North American automotive sector could become fragmented. US automakers would need to rethink their production strategies and global partnerships to adapt to this new reality. While a complete severing of trade ties is unlikely, the risk of long-term disruption is significant. The question remains whether Canada's move is a strategic bluff to pressure the US into backing down on tariffs or the beginning of a fundamental realignment in global auto trade. Some analysts believe this is a political maneuver designed to force the US to reconsider its aggressive trade stance. Others argue that Canada is genuinely pivoting toward Europe to secure long-term stability outside of US influence. If Canada fully commits to this path, US automakers will face serious challenges. Higher production costs, disrupted supply chains, and the loss of a key export market could force companies like Tesla, GM, Ford, and Stellantis to restructure their operations. They may need to find new suppliers or risk losing market share in Canada altogether. The outcome of this high-stakes economic brinkmanship will determine the future of North American auto trade. Canada's bold shift toward European partnerships sends a clear message: it will not be strong-armed by U.S. tariffs. Whether this is a temporary negotiating tactic or the start of a complete trade realignment remains to be seen. If the U.S. holds its ground, automakers could face skyrocketing prices, disrupted supply chains, and shrinking market shares. If Canada fully commits to its European pivot, the North American automotive industry could undergo a major transformation. European EVs might dominate Canadian roads, leaving American automakers struggling to compete. The coming months will be critical in determining the direction of this trade war and its impact on the future of the automotive industry.